Okay, hi everyone. Welcome to my latest in the webinar series of macro data, mastering the macros, and we're going to talk about inflation today. And the title of the webinar is "How Does Inflation Affect Financial Markets?" And basically, just to go through how it has a big impact actually across certainly forex markets and bond markets, but also to a certain extent equity markets as well. Just before I get into it, disclaimer as always. Just have a quick scan of that because I'm going to be talking about live market information as ever. So the disclaimer is important, and I'm going to show it again at the end for you. So that's important. Right, quick look at the agenda really. Discuss first of all why inflation is, what it is, and why it's the ways it's used, ways it's measured, and why it's important for the markets, and then basically how it impacts on various asset classes, really, sort of bond markets, forex, equities, and gold as well. And then I'm going to get through as quickly as possible because there's a lot going on in markets at the moment. Markets continue to be impacted at the beginning of the year, and live market analysis should be hopefully able to give you a little bit of insight into where they might be going next. As ever, give me a shout and ask me any questions you like. I will do my best to answer them, and anything you're looking at, just give me a question, and in either the chat box or the question box, I've got them both open, so hopefully I will see them. But just starting off obviously with a bit of the theory about inflation, really, I'm going to talk to you about the impact of inflation on the markets that you're trading. Anyone who took part in my last webinar on monetary policy will understand that monetary policy expectations, or effectively interest rate policy, have an enormous impact on financial markets. But what are the measures or what are the economic indicators that drive that monetary policy? And one of the most important ones is inflation. So broadly speaking, inflation is actually probably the biggest single factor that drives monetary policy, and hence it has a major impact on local currency, bond markets, and equity markets as well. Now, central banks will tend to have a prescribed level of or target level for inflation, and that's basically the level at which the central banks see inflation as being optimal for the economy. And the Fed, for example, Bank of England, Bank of Japan, all have a 2% inflation target rate. The ECB is a touch different. It's actually targets what is quoted as below but close to 2%. But what you probably have realised is that none of these central banks are anywhere near their inflation targets at the moment, and that is obviously causing them a real concern. If you look at the Fed, for example, its inflation target is actually down as part of statute and law, as part of its dual mandate, and it has a commitment to the quotation being stable prices, which, as I said, the FOMC targets the 2% inflation rate. It uses personal consumption expenditure, and just an aside, is personal consumption expenditure is actually the Fed's preferred measure of inflation, even though obviously there are loads of different measurements of inflation. The PCE is the one that the Fed looks at the most. So let's just look at a few technical terms before we get going, because there are different different terminologies that inflation covers. You've got inflation, disinflation, and deflation. Now, obviously, deflation is a big topic of conversation at the moment, or has been over 2015. But inflation is generally seen as the increase in prices from one period to the next, usually measured on an annual basis, or most usefully measured on an annual basis, and there are several ways of measuring inflation, and I will just touch on them in a little bit. But most commonly, traders watch out for the CPI, which is the Consumer Prices Index. Although, as I said earlier, the Fed and even the ECB look at different measures of inflation, but they're all rather similar in any case anyway. Next is deflation. That's where prices are still growing, but and there is actually inflation in the economy, but the level of inflation is actually declining. General level of prices still rising from one period to the next, but that increase is falling. For example, you've got an economy that has a trend of inflation that's previously been at 2%, falls to 1.5%, and thus then subsequently falling to 1.0%, is said to be in a period of disinflation. And finally, probably the most important or most interesting one is the concept of deflation, and that's where inflation has gone negative. It's where the general level of prices has fallen from year one to the next. There is a big debate about deflation and the impact that it has on the economy, and certainly there is, well, as Chancellor Osborne of the UK suggested, there is good inflation and good deflation and bad deflation. Bad deflation would be similar to that experienced in Japan, where it's a perpetual cycle. Deflation in the long run stifles confidence, stifles consumer spending and investment, and therefore the economy sort of moves into a deflationary spiral that pulls growth lower, and it struggles enormously to get out of, and that is hence what Japan continues to battle. You also have real levels of debt go up, which is a real issue. Obviously, anyone with a mortgage or anything like that it will struggle in a deflationary spiral, because the price, the value of their money, the value of their debt is not going down; it's actually going up, and they struggle to pay that off. However, you got the flip side of that, which is in the UK, where you had a couple of months or a few months in 2015 where deflation was actually considered to be a positive, because as long as deflation is considered to be a temporary component, then certainly in the case of the UK, it was sort of confined to staple items such as food and energy. It's actually considered to be a positive for consumers, because it's almost like a pseudo tax cut. But it's all about expectations of deflation, and if it's the market views as deflation as being here to stay, it can be very difficult to change the mindset of consumers. So, as this slide shows, high inflation is bad. Look at that's Weimar Republic, Germany. Famously, the reason why the Germans are so concerned about inflation and why the Germans always fight against Mario Draghi and the ECB and his attempts to sort of engage quantitative easing, because quantitative easing is considered to be inflationary in the long run, and the Germans inherently are against that. Certainly, as what happened in the early 20th century. Zimbabwe is another classic example where hyper inflation was a real problem. But then you've obviously got the impact of deflation as well, and you can see here the deflationary spiral. Now, what central banks are basically looking for is not one nor the other. They're looking for sort of a Goldilocks scenario. And why why central banks are willing to tolerate a small amount of inflation, because it sort of helps to generate economic activity if people know that the prices are going up, but in a small and measured way. It's considered to be a positive for the economy. So the central banks are basically looking for not generating too little inflation, because it runs the risk of the economy falling into deflation, or alternatively too much inflation, as it's bad because it erodes the real value of money. So they're basically looking for inflation to be not too hot and not too cold, the Goldilocks scenario being they want it to be just right. Joseph Solomon has got a question here. Would reserve banks increase interest rates on mortgage loans in a negative deflation climate? Well, what you do have at the moment is the prospect, which was it? My memory is belaying me here. There was a central bank. Oh no, Australia. That was it. Australia was basically the central bank was having to sort out inflation. The central bank was trying to deal with the prospect of falling inflation by raising interest rates with the fact that. Sorry, I'm getting a little bit confused here. In a deflationary environment, you need to have you can combat that by cutting interest rates to negative, which is what the Bank of Switzerland do, or the SNB, and also what the ECB is now trying to do. Now, would you increase interest rates on mortgage loans? Well, it's the banks still have to make their money, and then they do not make a money in a cutting interest rate environment because their margins are squeezed. So it is a possibility that they could still raise interest rates on mortgage loans if that is the case, because they still need to try and make some money. And obviously, we're in a negative interest rate environment. That is certainly not the case. And obviously, what you do have is the deflationary spiral effect that obviously the ECB and the Swiss National Bank are trying to avoid. So it is possible that banks would increase their interest rates on those loans to try and sort of make a business in that environment. But it's not an entirely prescribed view, but it is a possibility, I think. Yes. Sorry about the confusion about Australia. I think I was getting a bit mixed up with something else there. But yes, that is possible. Right. Okay, so a couple of looks at different inflation measures. You've got CPI, which is the basically the accepted international gauge of inflation. It's going to have a big impact on certainly domestic currency, but also bonds. You would probably be looking more at the core versus the headline view. Headline CPI includes volatile prices elements such as food and energy. So you strip out that by looking at the core CPI. Especially now at the moment with this huge decline in energy prices, which is why we've got CPI figures down at basically flat, but the core data is actually around about 1%. It's actually you've actually got that in the Eurozone, but also UK and the US as well. You've got inflation core inflation around about 1% higher than headline inflation, and that's because of they're still trying to. The headline numbers are still sort of got the huge decline in energy prices still in them at the moment. But the theory being, as those energy prices fall out. As the energy prices fall out of that calculation, then the headline data will increase again, which is basically what the central banks are hoping for. Again, look at year-on-year data. I talked about this previously, but I think year-on-year versus month-on-month is obviously much better steer, because month-on-month you don't really get a good trend. You get the trends through the year-on-year data, and that is basically what the markets is looking for. But yeah, so look, I would tend to look at core year-on-year data as your main measure. Personal consumption expenditure, as I said, that's the Fed's preferred measure of inflation. It looks at household expenditure on goods and services, focusing on individual consumption, and that's basically why the Fed likes it. Perhaps one of the reasons why it actually prefers it to CPI is because it focuses on the changing consumer habits and not just the fixed basket nature that is CPI. So that's one of the reasons probably why the Fed does prefer it, and also accounts for 2/3 of final spending in the US as well. The Harmonized Index of Consumer Pricing, or HICP, is the ECB's preferred measure of inflation. Very similar to CPI, but just with a methodology that harmonizes it across the Eurozone, really. You've got other measures that the market will look at. Average earnings, which will be a very important measure at the end of this week, because average earnings for the States is contained within the employment situation report, in other words, non-farm payrolls report. Market is certainly looking out for average earnings to pick up in the States, because average earnings or earnings growth is seen as an indicator of how wages are growing, and subsequently wage growth is seen as a key factor in determining living standards, and subsequently is if you've got wages going up, then the chances are you're going to be spending more money, and subsequently inflation will be following soon thereafter. So what you're looking for is if nominal earnings growth is consistently higher than CPI, then real wages will be rising, and people's living standards will be increasing, and therefore you're going to get an indicator of future inflation down the road. As I said, Friday's non-farm payrolls report is where you're going to get the latest US data, so watch out for that. The earnings growth, it's been around about 2 to 2.1, 2.2% for ages now in the States, and you're sort of looking for that growth to pick up towards 2.5%, maybe even 3% on the average hourly earnings, and that would certainly be a measure that inflation is sort of ready to come through in the States, because basically the PCE in the US has been, or the core PCE on an annual basis has been at 1.3% for a long time. Other measures, employment cost index. That's a quarterly bit of data actually for the States, and it looks at a measure of labour cost for employers in the States, because wages and salaries actually constitute around about 70% of the total employment costs. So it's seen as a strong indicator again for the potential for earnings growth and subsequently inflation, really. The final one is PPI, which is Producer Prices Index, also known as factor gate inflation, and measures the changes in selling prices that domestic producers of goods and services receive. Again, it's sort of seen as a theory that increasing in PPI will subsequently see further down the road retailers pushing their cost increases onto the consumer, and therefore help to predict potentially CPI, or Consumer Prices Index. So why is inflation important? Well, central banks look at inflation as one of the primary gauges of how to implement monetary policy, as I said earlier. If inflation is rising, then a central bank will be sort of it will need to consider the potential to raise interest rates in order to keep a control on prices. And it works by an increase in interest rates makes it more expensive to borrow, and subsequently that chokes off the demand in the economy. So inflation can therefore have an impact. Have a direct impact on monetary policy, and as I said here, you've got the diagram of the Fed's dual mandate, which is price stability and maximum employment, as the two parts of the dual mandate which derive its monetary policy, and obviously inflation is a big factor in that. And what you've got here in this box is basically where rising inflation above target levels needs to be dealt with through tighter monetary policy, and that's how it works. Right. So how does it affect markets? Well, just as a general, really, it's a general rule. Inflation is going to be negative for bond prices. It's going to be positive for currencies. Or the domestic currency. It's going to be difficult. It's difficult to actually gauge the impact on equities, and depending on what the level of inflation is, hard commodities such as gold will also be impacted as well. But let's start with bonds very quickly. Bonds are very sensitive to changes of inflation. It's basically the market's view of interest rates, of inflation in, the diagram here, we've got the US 10-year Treasury yield. So it's basically the market's view of inflation in 10 years' time for the US. And it's basically the reason why bonds are so sensitive to changes in inflation is because it's due to the potential impact it may have on monetary policy, because expectations of future monetary policy will certainly derive bond prices. The reason being because the bonds have a fixed income property. And if bond markets expect inflation to rise, the theory being that will increase expectations of a rate hike or interest rates increasing, and therefore the bonds will come under pressure because of the fixed income nature of their or fixed income properties that they have. So if you've got it's basically due to a sort of an opportunity cost aspect of it. If you've got inflation that is rising, interest rates going up, the interest that you get on a bond is not going up. So if you're going to get more money through other means because interest rates are going up, i.e. cash, then you potentially would be selling off your bonds because you could prefer cash, really. And that is why there is a sort of a negative correlation between interest rates and bonds, purely because of the fixed income nature of it. They think of it as like a bit of a seesaw as well, and markets tend to sort of look at bonds through the yields, unless you're trading them, of course. But the measurement of bonds tend to come through its yield, and increasing yields is sort of a reflection of decreasing bond prices. So it's all about the fact that investors will switch their preference to assets that are paying a higher level of interest. And as you can see here, you had the announcement of US CPI inflation. Data came in stronger than expected, and therefore treasuries were sold off, sending yields higher. This was in October. And there's a lot of volatility on that move, actually. You can see from 1.9980 added, quite a significant amount, actually, on that CPI data in the following minutes. FOREX. Now, this is an interesting one because what you have is, again, FOREX will be significantly impacted by inflation. And again, it's due to the close links between inflation and monetary policy. And interest rates, again, have a big impact on FOREX because they derive hot money flows. Now, rising inflation improves the likelihood of an increase in interest rates, basically, and in turn it increases the demand for local currency because of the changing expectations. And now this is important across all economic indicators, really, because of changing expectations of interest rate differentials, and that is basically driving hot money. So basically, if UK inflation is going up, euro inflation or eurozone inflation is going nowhere, then that should be strong for sterling against the euro, because changing expectations of interest rate differentials. So your hot money will flow from the euro into sterling, and therefore euro sterling would go up. Oh, sorry, down. Euro sterling would go down. Now, let me just show you very quickly, because in the last couple of days there's actually been a very good example of this, not actually on euro sterling, but on euro dollar, because what we had, let me just zoom out. You basically had yesterday, you had the announcement of German inflation, German CPI. German CPI was announced at 1 o'clock in the afternoon. Up until then, you could argue that the euro had basically gone not far off sideways, a little bit up, a little bit down, trading in basically about a 40 tick range. And then suddenly at 1 o'clock you had a massive disappointment in German CPI inflation. It was actually forecast to go to 0.6%. It actually fell from 0.4 to 0.3, so a big disappointment, actually. Now, the fact is that German CPI is seen to be a very strong gauge for Eurozone CPI as a whole, because obviously the German economy is the most productive and strong economy in the Eurozone. So the disappointment in German CPI would hence be likely to be a disappointment for the euro inflation, Eurozone inflation across the board. And what do we see? We saw since that 1 o'clock, when around about say 109 on Euro is now 170 ticks down from that, because it's had not only the German CPI disappointment, it's also had subsequent Eurozone CPI disappointment too. And you can see since that data, or in the hours following that data, up and for about 3 hours, it actually fell about 120 ticks. So there is potential to certainly trade these things on disappointments, and you don't get the instant market reaction, and that's it. You do get a chance to continue to play it in the direction of the surprise. In this case, the disappointment of lower than expected German inflation would suggest that you'd need looser monetary policy from the ECB potentially, and subsequently we've got a selling pressure on the euro. And that was a very interesting move that we saw yesterday. That has actually continued again today. So here's another example. Back in October, we had sterling dollar. Again, disappointment on UK inflation. Disappointingly fell to 0.1% negative. It was actually expected to be flat, I think, or even up. I think it was flat was the expectation that month. And sterling got sold off on the back of that. It was actually sold off in front of it, but subsequently kept on going on the data release. Didn't really stop. That was when it was at 153. Sterling currently now trading at 146.50, which is quite a big way down from where it was just 3 months ago. Equities. Now, this is a difficult one actually, because the impact of inflation on equities is quite difficult to measure really, because the performance is uncertain. The performance of equity markets is uncertain. In this case, as you can see, the German DAX just slightly went higher, not a huge amount. Eurozone in just the end of September, Eurozone flash CPI unexpectedly fell to 0.1% negative. Now that sort of drove expectations of further monetary easing. Easier monetary policy or lower interest rates tends to be positive for equity markets. But it's a difficult one to really gauge, because you could argue also that the Eurozone, in the Eurozone, you want to see economic activity improving, and economic activity improving would be sort of shown through an increase in inflation. So there's sort of like a double-edged sword, really. The reason the DAX sort of crept up, I suppose, was on the expectation of looser monetary policy, and it just really depends on where you are in your base case scenario, really, for inflation. I mean, it depends on where you're starting. In this example, the Eurozone's been struggling to generate inflation, and any uptick in inflation would be considered to be a positive. But it depends on where you are, because if you're looking at inflation starting at around 5, 6, 7% maybe, then I suppose an increase in inflation would be deemed to be less positive. But if you're at a base of maybe 1%, then it's considered to be a positive. But you don't want to see inflation strongly above that target level that all these central banks are sort of have targeted. So it is a difficult one to really gauge the impact on equities, and again, it sort of ties into the whole monetary policy angle that you have in terms of interest rates. I mean, lower interest rates means it's cheaper to borrow corporate in terms of corporate debt, but also borrowing at the bank. So that's a positive for companies as well. So I mean, there are loads of different arguments actually in terms of how inflation impacts on equities. Right, so the big one really, well, I say big one, probably the most important one is gold, in terms of trading, because you do get a lot of volatility on gold around inflation data, especially US inflation data, or certainly big big global central bank data. Obviously, inflation in the US is a big aspect of the price of gold in dollars. Rising inflation tends to be seen as a positive for gold, actually. Gold, the theory being gold is seen as a store of value, and the world is basically now filled with fiat currencies. A fiat currency is basically paper currency not backed by physical hard assets, and hence why gold actually soared higher when QE became the monetary policy of choice a few years ago. However, the price of gold has basically, in the last couple of years, has been consistently falling away, basically because you haven't got inflation. And inflation is seen as a driver of positive gold prices. So inflation not filtering through, despite that huge QE drive, gold's seen as being a traditional inflation hedge, and gold will tend to rally as expectations of inflation increase. Again, it really depends on real interest rate, or the level of real interest rates. Basically, real interest rates being where, or positive real interest rates being where the interest rate level is higher than inflation. Now, if real interest rates are positive, that should mean that the opportunity cost of holding gold increases, and therefore demand will fall. So you need to look at where interest rates are versus inflation, and a period of negative real interest rates where inflation is higher than interest rates, that is actually going to be a positive for gold, because it's sort of seen that it's a big inflationary move that is sort of eroding the store of value in money, and because gold does not have a yield, it's better that inflation is above interest rates, because you don't get any money for your gold. But with inflation being higher than interest rates, it's actually seen as a positive rather than a negative. Just to leave you with one little thought on this as well, the Fed recently increased interest rates, didn't it? And you're not really yet seeing gold coming through as you're not seeing inflation coming through in the US. When inflation starts to come through, I think that's going to be deemed to be a sort of positive for gold. But at the moment, with inflation being rather sort of stunted in the States, you could still see that any rally on gold is going to be difficult to come through in that environment, where in the US is increasing interest rates, so the opportunity cost of holding gold goes up, and obviously you get more interest on your physical on your cash holdings, but with inflation not going up, then the arguments of holding gold are stunted. So so at the moment you could still see gold struggling to take off, but once you start to see inflation coming through, then maybe you'll see gold being a little bit more positive. Right, okay, well that sort of brings to the end that theoretical side of it. Let's just look at live markets. Now this, oh dear, euro. Let's start off with euro. I'm going to go through the forex majors sort of one by one, really, and it's not looking great on the euro. I've been talking about this 108.10 key level, basically just to sort of zoom out. You've got the euro in this big broad band, almost sort of like 1,000 ticks between the bottom at 104.56 and the top, which was around about 114.60 area. Interesting that we saw the medium term through the sort of second half of last year, the medium term support coming in at 108.10. That has become a pivot level. Became resistance once you broke it to the downside, and then breaking through that, it became supportive, and now we're breaking down, and it certainly seems to be that we're confirming that breakdown today. 110 ticks down on the euro on the day two very negative trading days on the euro in a row. Look at these momentum indicators. They are looking pretty awful, actually, all turning lower. Stochastics very negative, accelerating lower. Certainly look as though they've got more downside potential, don't they? Your 108.10 mark, as it did back in mid-November, could now become your basis of resistance. It looks like we're going to get a confirmed close below 108.10. I mean, that's pretty much nailed on, I would imagine now, unless you get something crazy going on in the States, but I don't think it's going to happen. So that would be a confirmation breakdown of that 108.10 mark, and that would then become your basis of resistance. That old supports becomes new resistance. So having broken down, it looks, and also looking at the hourly RSI as well, that's a very negative move. You've got RSI at 18, that would suggest a strong trending move to the downside. MACD lines also negative, and stochastics pretty negative as well. So certainly now you'd be looking at using any rebounds as a chance to sell. And it likelihood is you're now going to get probably a test of that key reaction low that we saw just prior to the ECB decision, 105.40 area. Now, in terms of your initial supports, just to zoom in, you could argue that sort of these, or the 106.90 is a sort of an element of support. Just get my crosshair on it, which is basically that reaction high that we saw on the 25th of November. It sort of coincided with all these lows around 106.90 to 107 area. So that is arguably a basis of support. It'll be interesting to see if it does hold, because if it does break, then I think you're going to have to sort of talk about 105.40. So 106.90 is your sort of almost last chance saloon support. You could argue there's another sort of minor level of support around 625, 630. Sort of, again, old support being new resistance. That resistance subsequently becomes supportive. So 106 sort of 30, 106.40 area, but I wouldn't say that is a particularly great support in place there. What from Scott Pickering, what charting service are you using? This is Reuters Icon, actually, which is Reuters their special package that sort of supposedly challenges Bloomberg, although you don't get anywhere near as much information on it. But still, I think the charting aspect of this package is very good. So it's Reuters Icon. It's very good. So yeah, basically Euro looks pretty hairy now, I think. It looks like it's coming back for a test, so selling into any intraday rallies that you might get maybe tomorrow. Don't forget you've got payrolls data this week as well, so there's usually significant volatility around payrolls, so be careful on that front as well. But certainly we could have a lot more volatility in this week as we go on. Right, cable. Again, I've been talking about in all my daily morning report videos and chart analysis. It doesn't look great, does it? It looks like, if I get rid of the crosshair, it looks like we're just going to come back and retest that April low, 45.63. Not too far away from that now, really, just 90 ticks away. Momentum looks pretty negative, doesn't it? Not too far away from being sort of around oversold levels now. That reaction low that we saw in September was 26.5, so it may well be that we're going to get a bit more downside, maybe even a test to that 45.63, but then subsequently you might see a bit of a rebound, actually. And again, you've got quite a lot of tier 1 US data this week that can drive cable, specifically looking at this ISM non-manufacturing, and also UK services PMI as well. Two very important bits of data tomorrow, actually, that will be driving cable near term. So watch out for that, but certainly you'd say that just the consistent selling pressure coming through cable, lower highs, lower lows, consistently finding just the sellers coming in at lower levels. So just any sort of rebound, and you got that yesterday. You had the if I sort of look at cable on an intraday basis, you had this move on cable yesterday, and again in my morning report I spoke about the old resistance, the old support around 48 figure coming in and acting as new resistance. Old support of sort of late December, and again it basically hit it almost nailed on, and since then we've been falling away again. Little minor bit of support that we saw on the last trading day of the year becoming new resistance, and again falling away. You could argue that we're now sort of adding to that resistance. So I'd say 47.20 area, if you get it, which is 80 ticks up from here, looks to be a reasonable near-term level. It's around about where that falling 89-hour moving average is, or it certainly will be tomorrow. So 47.20 area I think could be an interesting level tomorrow. But looking at the hourly momentum, it's negative across the board, isn't it? Look at just the consistent sort of little bounces, little unwinding moves on the hourly RSI before the selling pressure kicks in again. That one got a little bit higher than perhaps it should have done, but again, anything around the sort of 50 towards 60 area looks to be a chance to sell. Look at the MACD lines as well. Anything that sort of unwinds back to neutral is seen as a chance to sell. The stochastics are on the hourly chart a little bit stretched to the downside, you can argue, so maybe you're starting to think about another technical rally, and again you'd think about sort of resistance in the 47 to 47.20 area that you might see as a little bit of a sort of an overhead supply, but certainly the pressure is continuing on cable. Just the number of negative candles that you get on cable, and the fact that just the rallies just get consistently sold into is pretty concerning, I think, from a technical basis, unless you start to see some positive economic data coming through for the UK. It doesn't really look as though we're going to get too much of a bounce in cable, because it looks like the market is just reassessing the expectations of a potential rate hike in 2016 for the UK. Doesn't look as though, or certainly the way the market is moving anyway, it doesn't look as though that a mid-2016 rate hike is likely at the moment, in my opinion. But it'd be interesting to see how it pans out. Ultimately, you've also got the problems over Brexit as well, which is a horrible word. Britain's potential Britain exit from the EU would certainly have negative implications for cable, and that seems to be what the market is gradually pricing in. And maybe the closer you get through the year, the closer you get towards what seems to be likely to be a June vote, actually a June referendum. And the closer you get to that, maybe you'll get some polls which suggest that Brexit is not going to happen. And then you'll probably get a bit of a rebound. On the Scottish referendum, for example, you had a sharp selling pressure in front of the Scottish referendum. Then you had a massive rally as the polls came out that suggested that there was going to be a no vote to the referendum. So the likelihood is that that's probably going to happen again. You're going to get selling pressure in front of that, and then you're going to get, as the polls come out during the middle of the year, if it is indeed a June referendum in the UK, as the polls come out and suggest that the downside is that Brexit is unlikely, you're likely to get a bit of an unwinding rally on cable. But certainly for now, it's negative. Okay, dollar yen. Again, selling pressure. Safe haven trading, you'd certainly argue, is the trade of choice at the moment. Look at this 23.6% fib level. Very interesting. 23.6% fib of that sell-off in August. Fib levels haven't been doing too badly with this sell-off, actually. Consolidation around the 76.4. Slight consolidation above 38.2%, but then again almost hitting 23.6. 23.6 being this basis of support that we had through September and October. So this is clearly a big level of support around that 118.50 level, isn't it? On dollar yen. 1868 was yesterday's low, 1877 today's low. So you tend to get this buying that comes in around that sort of 1860, 1870 level. Interesting. The momentum indicators are negative, you would argue, certainly. I mean, RSI lowest since August, since that big sell-off. That was a big acceleration move, wasn't it, to the downside? And it'll be interesting to see exactly how this pans out. But I think that 118.50 is a key level of support area around that fib level. So the fact that 2 days in a row is sort of bounced off that, or just above that level, could be interesting with the RSI below 30. On dollar yen, again, dollar yen is a chart that very rarely gets sort of extreme, unless it's a trending move. Dollar yen tends to sort of trend sideways a lot. This is currently seems to be playing out as a trending move, so it would be very interesting to gauge if this sort of consistently trades below 30 on the RSI. Would that mean that we're going to get a move back towards that 1646 key reaction low from August? It may well be, but I think in the meantime you'd be looking out for that 118.50 support level of that fib. Now let's just look on the hourly chart to see if anything interesting is going on. You'd say that you've got an element of resistance around that 120 figure level, and the basis of resistance comes in around that sort of 119.70. So it's interesting, as I said, that we've got today's low, which is above yesterday's low, even though we've had another very negative move on the markets today. Again, this hourly RSI failing around the mid 50s. Again, the MACD line's rolling over under neutral. So momentum is still very negative, but I'd be certainly looking out for, if you started to see the RSI above that 55 level and holding, maybe the hourly MACD lines moving above neutral. The stochastics, interestingly enough, on the hourly have just turned up, which is supportive, certainly. And again, that sort of plays into this whole aspect of this sort of 118.50, 118.60 support band on the daily chart. So I think this is one to maybe just to watch, purely because of the fact that you don't want to be consistently selling around a big support level. So it's interesting that at the moment that big support level is holding. Okay, let's look at the Aussie. I think the Aussie is back at this big support line, isn't it, of this big uptrend. Not too far off it. You've got the daily RSI. Again, high 30s on that daily RSI. It's currently at 41. High 30s throughout the trading over the last sort of few months. The RSI has sort of continually bounced off sort of high 30s, sort of back to 41 now. Does that mean that the basis of support could well come in? Obviously, the key support is that 7090 level, which was the key December low. If you saw a breakdown of that, that would complete a breakdown, arguably a small top pattern, which you'd argue would reopen these key reaction lows of November, which is sort of 715 area. But at the moment, you've still got the uptrend intact. Not looking too negative yet on the momentum indicators. As I said, the daily RSI sort of coming back to a level at which the support has tended to come in. The interesting thing, for the bears certainly would be this sell signal on the stochastics, which is a negative certainly. But I'd be looking out for this RSI around the mid 30s. If it starts to sort of fall below that level, starts to go to the sort of low 30s, then yes, I think you'd be sort of breaking down. The likelihood is you're going to be breaking that 7090 level. But the last couple of days has certainly been really negative. I mean, again, plays into this whole safe haven trade aspect. Obviously, the commodity currencies are high risk or higher, deemed to be higher risk currencies. And certainly it looks like that is the case at the moment, that the high risk currencies are under big pressure. Near-term outlook is not great on the Aussie. Let's look at the hourly chart. Yes, that is the Aussie has just in the last hour or so broken down, and the hourly momentum is negative. That is not a happy chart, actually. And the fact that, I mean, I've got this level in here, 71.60 is actually sort of 71.60 area was actually an old neckline, but that is sort of like a pivot, big pivot level, isn't it? Basis of support again yesterday, and then broken decisively, so that could now become the basis of resistance for a rebound. So 71.60, 71.70 area, be looking for next sell signal if you've got a rebound. But looking at the momentum here, the hourly RSI positive up until just a few days ago, really, but since the turn of the year it's just been turned very negative, and it looks to be that we're going to get a probable retest of that reaction low at 17.90. So zooming in, you'd look at these candles and you say, well, yes, that's a key 1 hour reversal or or a bearish engulfing candle. That's not great. Subsequently, we've seen the last couple of hours which are negative, or certainly last hour was negative. Seeing a closing, that was a closing breakdown of the support at 71.60. Momentum indicators on the hourly chart negative as well, so it doesn't look all that hopeful. It looks as though the Aussie could well continue lower. That uptrend on the daily chart comes in around 71.15 at the moment, which is about 20 ticks away from where we are. So it looks like that could well be tested now. But some really interesting signals that we're getting on the Aussie. Kiwi. Whoops. Yeah, we've had a breakdown. Just before I did this, I sort of measured you got this uptrend channel. When you break down from a trend channel, you can measure the height of the channel and project it downwards. And if you do that, it comes bang on that old pivot level, 66.15. 66.15 since October has been a key pivot level. Actually, yeah, you could measure it further back than that, as it came in at the end, sort of mid-July, and also mid-August, although a couple of times it sort of moved through it. But since then, it has been a very strong indicator, and you could well see that that is seen again. So that is 66.15 could now be tested on this Kiwi chart, and the momentum indicators don't look great, do they? The stochastics certainly giving a sell signal now. MACD lines crossing below. RSI as well on the daily chart doesn't look all that great. Certainly suggests, let's see, that that support 66.80 being tested as we speak. 66.80. A breach of that key reaction low would certainly confirm that. I mean, it is confirmed anyway because of the close below it and the sharp bear candle that we've had since then, but certainly would suggest the end of the bull run and a move back towards 66.15. It'll be, I wouldn't like to call it beyond 66.15 because of this sort of quite consistent nature of this pivot at 66.15, but it certainly looks like it's coming back towards there, which is around about 70 ticks lower from here. But certainly the daily momentum indicators reflect all that weakness. Come on, chart's not responding. Come on. Right. So let's just look quickly at the hourly chart. Again, it's just going to be a similar thing. Lower highs, lower lows. Broken uptrend channel. Old support becomes new resistance. Again, old support becomes new resistance. Let me just get that crosshair in. You can see if it actually works. Old support around that sort of 67, 60 level became new resistance this morning. Subsequently, that reaction low that we saw yesterday become the resistance today, and then selling off to the downside. And we're now, as we speak, testing this key level around 66.80. Not confirmed yet, certainly, but it looks like it's negative. And look at this consistent deterioration actually in the hourly RSI. Lower highs, lower lows. You could have sort of started. You were starting to think certainly that this strong run higher was losing momentum as you started to sort of wane away at the end of the year. Certainly negative configuration now on hourly RSI, MACD, and stochastic, so it doesn't look great. Okay, I haven't got long, so let me just look at gold. Oh, gold. Why are you doing this to me? I've been talking about gold for a while. 1077. This old key floor, 1077. Look at the amount of times that 1077 has acted as the basis of resistance. Overhead supply is everything, or not everything, but overhead supply is really important, I believe, in technicals. Certainly in the sort of sell-offs and then subsequent rebounds. And again, 1077, every time it gets above 1077, it sort of falls over. You've got a couple of closes above, but again, the next day, subsequently, it sells off. So you'd need 2 daily closes, I believe, above 1077 to really see this improvement. Again, in the last 3 or 4 weeks, every time 1077 or above 1077, it's failed on an intraday basis. Again, yesterday, 1083.30 failed, closing at 1074. Today, 1082. Coming back, so again, it's just not really able for the bulls to get hold of this one. It's a big level, I believe, 1077. Big level of overhead supply continually coming in as the basis of resistance and failing. And at the moment, the gold price is sort of moving sideways, but there is the prospect of this potential little base pattern on a move above 1088.70, but again, every time it gets above 1077, it just falls over. So you'd say you're neutral medium term, certainly, on gold. And near term, it's slightly positive, but again, I'd be concerned about that 1077 resistance. It is a bit of a worry. Let's look at oil. How's oil done today? Oh dear. Again, a small base pattern in place. 37.75. That old floor became the new resistance, sort of basis of resistance. So between 37.75 up towards 38, sort of 30 area. Yesterday you had a spike towards 38.40, but failed, and the oil price has rolled over, or rolling over. You still wouldn't say that you're getting overly negative yet. I mean, you'd argue that there is a bearish bias in the trading over the past few days, but nothing too significant. Momentum indicators reflect that sort of stochastics beginning to roll over. That's not all that positive. It's a bit of a disappointment because I'm really fingers crossed. I'm hoping that the oil price can start to recover a bit, because that would give you sort of the added bonus of improvement in risk appetite. I think across the board that would help stock markets, help the commodity currencies, certainly things like that. So not quite being able to do it yet, not yet, but it's not disastrous quite yet, but still technically you'd look at the 21-day moving average, which again a basis of resistance, continually failing around that level. That's not great. All the moving averages are negative. So for now, you'd still say that this is just a bear market rally, because looking at the momentum, you've just unwound the RSI back towards that 50 level, haven't you? And it's sort of failing again. It is a disappointment in my opinion, but it's not lost quite yet, because if you did get a bit of a rebound, I say if you got it, then you could see a bit of a recovery above that sort of 37.75 and then possible base pattern. But at the moment, that is a big level of resistance, 37.75, and that needs to be broken on a couple of days close, I'd say. Certainly you'd probably be looking for confirmation above 38.40. Okay, so pretty much that is my presentation. Don't forget you can go onto our website, handtechfx.com/market-research. All my stuff's there. Daily analysis, morning report. I also do videos as well. All my videos are there. My Twitter handle is @handtechrich. If you want to tweet me, I will tweet you back. And with that in mind, I wish you good luck in your trading. And here's the disclaimer. And I will speak to you again next time. Thank you very much for listening.